Module objective: to equip you with a comprehensive understanding of the financial instruments, funding options, risk exposures, and mitigation strategies in agricultural commodity trading. This module covers the key financial institutions, credit mechanisms, insurance tools, and hedging techniques required to manage the complex financial and operational risks involved in agricultural trade. Importance of finance in agricultural commodity trading. Agricultural commodity trading is highly capital-intensive and exposed to multiple uncertainties, from fluctuating market prices to logistics disruptions and climate variability. Finance is the lifeblood of any agricultural value chain activity, especially trading. Without sufficient financial access, farmers may be unable to transport or store goods. Traders may fail to bulk purchase from producers. Exporters may lack the liquidity for quality control, logistics, and customs processes. Retailers may struggle with inventory financing. Hence, financing determines not only access to commodities, but also when, how, and where trading occurs. Second sources of finance for agricultural trading. 1. Personal equity capital self-funding by farmers or traders. Limited, but often the only source for small-scale actors. 2. Commercial bank loans, offered by banks and microfinance institutions, may require collateral, formal records, or business registration. 3. Agricultural development banks and government schemes provide subsidized loans and grants. Example: Bank of Agriculture, BOA, Nursel Microfinance Bank, CBN Anchor Borrowers Program. 4th, input credit from suppliers. Traders or processors may provide seeds, fertilizer, or pesticides on credit, repayable after harvest. 5. Cooperative financing. Farmer associations and cooperatives pool resources or access group loans from financial institutions. 6. Trade credit. An agreement to buy inputs or sell produce with payment delayed to a later date. 7. Warehouse receipt financing. Commodities stored in certified warehouses are used as collateral to obtain credit. 8. Fintech and digital lenders. 7. Foreign exchange risk for export-oriented traders. Currency devaluation or fluctuations in exchange rates impact the cost or value of commodities. Digital platforms provide loans using mobile-based data and credit scoring. Third key risks in agricultural commodity trading. Agricultural trading involves exposure to various market, production, and logistical risks. Understanding these risks is essential for designing effective mitigation strategies. 1. Price risk. Fluctuations in commodity prices due to global markets, seasonal cycles, or currency instability. 2. Production risk. Uncertainty due to pests, diseases, or adverse weather affecting yields and availability. 3. Quality risk. Commodities may degrade due to poor handling, lack of storage, or adulteration. 4. Market access risk. Barriers to access domestic or export markets due to trade restrictions, poor road networks, or political instability. 5. Logistics and infrastructure risk. Delays, breakdowns, or inefficiencies in transport, warehousing, or processing can cause losses. 6. Credit risk. The possibility that a buyer or debtor fails to repay on time or at all. 4. Risk management tools and strategies. A. Insurance products. Crop insurance protects against yield losses from weather, pests, or disease. Livestock insurance covers mortality or disease outbreaks. Trade credit insurance, DOT, covers default by buyers. Transport and warehouse insurance, DOT, reduces losses from accidents, theft, or spoilage. B. Hedging instruments. Futures. Contracts. Agreement to buy, sell at a predetermined price in the future. Options. Contracts. DOT. Right, but not obligation, to buy, sell at a set price. Forward contracts. Customized agreements for future delivery at an agreed price. These tools are used primarily in formal commodity exchanges and large-scale agribusinesses. C. Diversification. spreading investments or trading activities across different commodities, regions, or buyer groups. D. Cooperative marketing, risk shared among members, greater negotiation power, better access to finance and buyers. E. Contract farming and outgrower schemes, ensures guaranteed markets and pricing. Traders commit to buying in advance, often providing inputs and technical support. F. Due diligence and documentation, proper contracts, record keeping, verification of partners, and legal advice reduce fraud and financial exposure. V. Role of financial institutions and support systems. Financial institutions act as risk absorbers and liquidity providers. Many now use agri-risk analytics and geodata tools to evaluate creditworthiness and manage risks better. Development banks offer long-term loans. Microfinance banks serve rural traders. Fintech startups provide real-time lending with minimal documentation. Development organizations, e.g., IFAD, USAID, support risk management pilot programs. Sixth summary. Finance fuels the entire trading process, from sourcing, packaging, transportation, to final sales. Multiple risk types, price, quality, logistics, and credit can destabilize agribusiness if unmanaged. Risk mitigation through insurance, hedging, cooperative systems, and smart finance is vital. Building financial literacy, formal records, and relationships with institutions enhances access to capital and reduces vulnerability.